the economic outlook remains strong. While many factors shape the economic outlook, some of the headwinds the U.S. economy faced in previous years have turned into tailwinds. In particular, fiscal policy has become more stimulative, and foreign demand for U.S. exports is on a firmer trajectory. What we've seen is incoming data that suggests a strengthening in the economy. We've seen continuing strength in the labor market. We've seen some data that will, in my case, add some confidence to my view that inflation is moving up to target. Gradually reducing monetary policy accommodation will sustain a strong labor market while fostering a return of inflation to 2%. Engaging the appropriate path for monetary policy over the next few years, the FOMC will continue to strike a balance between avoiding an overheated economy and bringing PCE price inflation to 2% on a sustained basis. My personal outlook for the economy has strengthened since December. And again, each member of the FOMC is going to be writing down a new set of projections and a new estimate of appropriate monetary policy as we go into the March meeting, which begins 3 weeks from today. And so I wouldn't want to prejudge that new set of projections, but we'll be taking into account everything that's happened since December. Flattening of yield curves in the past has been a sort of a precursor of recessions, but largely because in many prior recessions, the Fed had to raise rates quickly to hold inflation down. That's not the situation we have now. It's very typical for the yield curve to flatten as short-term rates come up as the economy strengthens, and I don't see a particularly large. There's always a risk of a recession at any given point in time. I don't see it as at all high at the moment. In the committee's view, further gradual increases in the federal funds rate will best promote attainment of both of our objectives.